Hey everyone, and welcome back. Today we're diving deep into something that's probably been on all our minds lately: market volatility.
Yeah, it's been a wild ride.
To help us make sense of it all, we're going to be looking at a recent YouTube interview with Chris Vermeulen.
He's the chief market strategist at thetechnicaltraders.com.
Exactly. And he was interviewed by financial analyst David Lin.
A great interview, by the way. I think our listeners will get a lot out of this.
So let's get right to it. The market's been all over the place, up one day, down the next. What did Vermeulen have to say about this recent upswing? Is it a sign of a new bull market, or are we just seeing a temporary dead cat bounce?
Well, Vermeulen, he's really into technical analysis.
Right. Charts, patterns, all that good stuff.
Yeah, and he started by looking at the NASDAQ Q.
Which took a pretty big hit recently.
Right before the interview, actually. It had a significant drop, but then we saw it bounce.
Which is what is everyone wondering, if this is the start of something bigger?
Exactly. So Vermeulen used a technique called a Fibonacci measured move to analyze this bounce.
Fibonacci, now that sounds complicated.
It can seem that way, but it's basically a way to identify potential turning points in the market based on certain mathematical ratios.
Okay, so what did this Fibonacci analysis tell him about the NASDAQ Q's bounce?
Well, he pointed out that the NASDAQ Q gapped down during that drop to what's called the 100% measured move, which, in simple terms, suggests that the initial bounce we saw might be losing steam.
So maybe not time to go all in just yet.
He thinks it might be wise to wait for more confirmation, really solid evidence of a sustained upward trend before jumping back in. He also mentioned something really interesting.
What's that?
During that big NASDAQ Q drop, there was a lot of panic selling.
Yeah, you could definitely feel it.
And that kind of panic often leads to what's called a short squeeze.
I've heard that term before, but I'm not sure I fully understand it.
So basically, when people are betting against the market, they're shorting it. And if the market starts going up, those people who shorted it are forced to buy back their positions to cover their losses.
Okay, so it's like they're trying to get out of a bad bet before it gets worse.
Exactly. And that buying frenzy can actually push prices up even further.
So this recent rally, the one that has everyone so excited, could actually be fueled by fear and forced buying rather than genuine optimism.
That's what Vermeulen's analysis suggests. He's really emphasizing the importance of looking beyond the surface excitement.
Don't get caught up in the hype. Look at the theta.
Exactly. Now, here's another interesting thing Vermeulen pointed out. He noticed a divergence between the Russell 2000,
Which tracks small cap stocks, right?
that's right, and the S&P 500, which focuses on the large cap companies.
And why is that significant?
Well, it suggests a possible shift in investor sentiment.
How so?
Small cap stocks are often seen as riskier, so when they start to lag behind the larger, more established companies, it could be a sign that investors are getting a bit more cautious.
Okay, I see. So it's like the little guys are getting left behind while the big players keep chugging along.
Right. And what makes this divergence even more intriguing is that it's the first time we've seen it since before that correction back on August 5th.
Oh, wow. So it's not just a random blip. It's part of a larger pattern.
Exactly. And this ties into something else Vermeulen talked about, the influence of the Magnificent Seven.
The Magnificent Seven.
Yeah.
I mean, like those old Western movies?
Not quite. He's referring to the 7 massive tech companies that have been driving a lot of the market's growth lately. The Apples, the Amazons, the Microsofts of the world.
Ah, got it. So how do these mega cap tech giants factor into all of this?
Well, Vermeulen argues that the way investors behave around these stocks can have a ripple effect on the broader market. Think of it like this. If investors start to lose confidence in these big tech companies,
Which could happen if their growth starts to slow down or something like that.
right, then that could trigger a sell-off that spreads to the rest of the market. And to make things even more interesting, Vermeulen points out that similar divergences, like the one we're seeing now between small caps and large caps, were observed before previous bear markets.
Oh, so it's like a historical warning sign.
It's not a foolproof predictor, of course, but it's definitely something to keep an eye on.
Definitely something to keep in mind. So let's say we're feeling a bit cautious, given all this information. What does Vermeulen suggest we do to protect our investments?
Well, he's a big advocate for cash.
Really?
Yeah.
Just good old-fashioned cash.
Yep. He believes that having cash on hand, especially during times of market volatility, gives you the flexibility to wait for better buying opportunities.
So instead of being forced to sell when the market's down,
Hmm.
you can just sit tight and wait for things to settle.
Exactly. You're not panicking. You're not making emotional decisions. You're in control.
That makes a lot of sense. But what about the whole inflation thing? Doesn't holding cash mean Your money's losing value over time.
That's a valid concern, and Vermeulen acknowledges that. But he believes that in uncertain markets like the one we're in now, preserving capital is paramount.
So it's better to potentially lose a little to inflation than to risk a big loss in the market.
That's his thinking. He'd rather see a small dip from inflation than a massive hit from a market downturn.
Makes sense. Protect what you've got.
Exactly. And if you're looking for a way to hold cash in a form that's easily tradable,
Because stuffing it under your mattress probably isn't the best strategy.
right, he recommends an ETF called DIL.
BIL. Okay. I'll have to look into that. So BIL is like an emergency fund for your portfolio.
You got it. Now, this is where things get really interesting. Vermeulen has a rather contrarian view on the US dollar.
Contrarian, meaning he goes against the popular opinion.
Exactly. A lot of people are bearish on the dollar right now, but Vermeulen actually suggests it might be a good hedge against volatility.
That's surprising. Why does he think that?
Well, he looks back at how the dollar has performed during previous bear markets. And you know what?
What?
It actually tends to do quite well. He even compared the current situation to the 2008 financial crisis.
Which is a pretty scary time for the markets.
Definitely. But the dollar held up remarkably well during that period. And Vermeulen's argument is that with commodities currently undervalued and stocks and real estate potentially overvalued, investors might start seeking safety in the US dollar.
So it's like a flight to safety, just like we saw in 2008.
Precisely. The dollar could become a safe haven amidst all the market turmoil.
Okay, I'm starting to see his logic. Now, let's talk about something that's been getting a lot of attention lately. Gold. It's been hitting all-time highs, and there's a lot of buzz about it going even higher. What's Vermeulen's take on this shiny metal?
He's definitely bullish on gold, but he emphasizes the importance of understanding its history.
Meaning, it's not always a smooth ride.
Right. Gold can be volatile, especially during those bear markets we were talking about earlier. But based on his technical analysis, he sees the potential for gold to reach $2,700.
Wow, $2,700. That's a pretty bold prediction.
He uses something called Fibonacci extensions and looks at historical patterns to arrive at that target.
Fibonacci again. It seems like that's a key tool in his arsenal.
It's definitely one of his go-to techniques. But even with his optimism about gold, he reminds us that it's not a risk-free asset.
So even gold, as shiny and appealing as it may seem, needs to be part of a diversified portfolio.
Absolutely. Don't put all your eggs in one basket, no matter how golden it might appear.
Wise words. Now, does he prefer gold over silver or maybe even mining stocks?
He does have a preference. He favors gold specifically. He sees it as having lower volatility compared to silver or mining stocks.
So in uncertain times, he sees gold as the more reliable option.
And with a higher probability of gains, according to his analysis. Now let's switch gears and talk about something that's been kind of out of favor lately. Bonds.
Yeah, it's not exactly the most exciting investment these days.
Well, get ready for this. Vermeulen actually believes that bonds are poised for a comeback.
Really? Bonds? What makes him think that?
He points to the potential for falling interest rates. Remember how we talked about the 10-year yield dropping?
Yeah, that was a big deal.
Well, that's a sign that interest rates might be heading lower, which is good news for bonds.
I always thought rising interest rates were good for investments.
It can seem that way, but when interest rates fall, existing bonds, the ones with higher interest rates from before, become more valuable.
So it's like supply and demand, but with interest rates instead of goods and services.
Exactly. And to add to that, Vermeulen reminded us that historically bonds have performed well when stocks decline. They can act as a sort of buffer in your portfolio.
So bonds aren't just for retirees anymore?
They can play a key role in navigating uncertainty. And here's another interesting thing. Vermeulen pointed out a specific pattern he's seeing in the bond charts, a bottoming pattern.
What does that mean exactly?
It's a signal that often suggests a potential reversal in the trend. Basically, it could mean that bonds are about to head higher.
So all those people who wrote off bonds might be in for a surprise?
They just might. And he's seeing this pattern in a particular bond ETF called TLT.
TLT, okay. Another one to add to the research list. So bonds could be an interesting play in this current environment.
Vermeulen definitely thinks so, and this all ties into his asset Reeves strategy.
Which we'll dive into more in part 2 of our deep dive.
It's a fascinating approach.
Stay tuned.
You won't want to miss it.
So we were just starting to talk about Vermeulen's asset Reeves strategy.
Very interesting concept.
Before we jump into that, I wanted to circle back to something else he mentioned about momentum indicators like the RSI.
Oh, yeah, the relative strength index.
Right, the RSI. Many traders use that to figure out if an asset is overbought or oversold.
See if it's time to buy or sell.
Exactly. And typically, a high RSI above 70 is seen as a sign that an asset is overbought.
Time to sell? Take your profits.
But Vermeulen actually has a completely different take on this.
Yeah, he really flips the script on that one.
He does. He actually gets excited when he sees those high RSI readings.
He sees it as a sign of strength, not weakness.
That goes against conventional wisdom. Why does he see it that way?
Well, he uses a great analogy. He says that selling when the RSI is high is like leaving a party just as things are getting good.
I like that.
It's like the momentum is strong, the energy's high.
Ride the wave.
Exactly. And to back this up, he actually mentions that he interviewed Jack Swagger,
The author of the Market Wizards books.
the one and only.
He's spoken to some of the most successful traders out there.
Yeah, real legends. And guess what?
What?
Swagger told him the same thing about RSI.
So it's not just Vermeulen's opinion. It's something that some of the best traders in the world agree with.
It definitely gives you something to think about.
It does. Okay, so let's get back to his asset Reeves strategy.
Yeah.
How does it actually work in practice?
It's all about active portfolio management. You're constantly rotating between assets based on their performance.
So instead of just buying and holding, you're making adjustments as you go.
Exactly. He calls it a consistent growth strategy, or CGS. He contrasts it with that typical buy and hold approach, the one where you just set it and forget it.
Right, the hands-off approach.
Yeah, but he believes that actively managing your portfolio can lead to much better returns. Over time, of course.
So instead of just hoping for the best, you're actually responding to what the market's telling you.
That's the idea. It's not about trying to predict every little move. It's about identifying which assets are strong.
Which ones have momentum?
Exactly, and which ones are showing weakness. And then you adjust your portfolio accordingly.
It's like surfing. You're riding the waves instead of getting caught in the undertow.
Perfect analogy.
Oh.
And to show how this works, he gave a real-life example from the COVID crash back in early 2020.
Oh, wow. That was a wild time.
His system actually triggered a sell signal for stocks
Right before the market tanked.
and a buy signal for bonds.
So he got out of stocks and into bonds just in time.
You got it. He was able to catch a 19% gain in bonds in just 9 days.
That's incredible.
And then, as that bond rally started to peak, his system told him to move into BIL. Essentially, he went to cash.
Sidelines.
Sat it out while everyone else was panicking. Classic wealth preservation. And then, about a month later, boom.
Back into stocks?
His system signaled it was time to buy, and he rode that wave higher.
So he's not just talking about the strategy, he's actually using it himself.
And it's clearly working.
Did he show any hard data to back this up?
Oh yeah, he actually showed a chart comparing his asset Reeves strategy to the S&P 500's performance, going all the way back to the 2008 market top. And the results, well,
They were pretty impressive, I'm guessing.
asset Reeves has consistently outperformed the S&P 500. Significantly higher returns.
Okay.
Way less drawdown, less risk, more reward.
That's the holy grail of investing right there.
It's about avoiding those huge losses that can really set you back, and then capitalizing on the gains when the momentum is there.
Makes a lot of sense. This asset reuse strategy really has me rethinking my whole approach to investing.
It's a real mindset shift. You're not just hoping for the best, you're proactively managing your risk.
You have a plan.
And a system, a set of rules that you follow no matter what your emotions are telling you or what the headlines are screaming.
Very interesting. Now, what about those who prefer a more hands-off approach?
The long-term buy and hold investors.
Right. Did Vermeulen have any insights for them?
He did. He acknowledged that not everyone wants to be an active trader, jumping in and out of positions.
Some people just want to buy solid companies and hold them for the long haul.
And for them, he reminded us that the long-term trend for the stock market is still up. His long-term charts, his indicators, they're still pointing to a bullish environment.
So there's still a case to be made for staying invested in stocks.
For the long term, yes. But he did add a word of caution. He's noticing some signs of weakness in the underlying technicals.
On the longer-term charts.
Right. It's like there's this tension between the long-term bullish trend and some potential warning signs brewing beneath the surface.
Mixed signals.
Exactly. And he actually compared this current situation to what we saw before the 2008 financial crisis. Back then, the market was still technically in a bullish trend, but there were these cracks starting to appear.
So even for long-term investors, it's important to pay attention to those signals.
Stay vigilant. And to wrap things up, Vermeulen made a pretty bold prediction. He suggested that if this current trend continues, we could see bonds rocket higher,
Wow.
while the Federal Reserve starts cutting interest rates.
Now that's a head-scratcher. How could bonds go up while the Fed is cutting rates?
It does seem counterintuitive, but Vermeulen argues that the market often anticipates these moves. The bond market might be signaling that things are going to change before the Fed makes any official announcements.
So bonds could be a good bet, even if the Fed is starting to ease up on rates.
That's what Vermeulen's analysis is suggesting.
It's definitely a lot to take in. Bonds possibly outperforming stocks, the Fed potentially cutting rates, all this uncertainty. What does it all mean for the future of investing?
Well, that's the million-dollar question, isn't it? And in part 3, we'll try to make sense of it all.
We've been on quite a journey, haven't we?
We have. It's been a deep dive in every sense of the word.
From those dead cat bounces to the power of the Magnificent Seven.
Cash as king, the potential return of bonds.
It's certainly given us a lot to think about, especially when it comes to this crazy market we're in.
What strikes me most is how Vermeulen really challenges us to think differently.
He does. He encourages us to question those assumptions we often make about the market.
Look beyond those flashy headlines.
And really dig into the data to develop our own informed strategies.
It's not about blindly following anyone's advice.
Exactly. It's about understanding the tools, understanding the indicators,
recognizing those historical patterns.
and then using all of that to make decisions that really align with her own individual goal.
Her own risk tolerance.
And his Asset Reeves strategy, he really embodies that adaptive approach, doesn't it?
It does. It's not some magic formula, one-size-fits-all solution.
It's more like a framework for navigating this constantly shifting market.
And whether you're an active trader or someone who prefers a more long-term buy and hold approach,
Having a system, having a set of rules that you stick to.
it can help you ride those waves of volatility with much more confidence.
It's like having a roadmap, but the roadmap's always being updated as the terrain changes.
You're not blindly following a path. You're constantly adjusting your course based on the latest information.
The latest signals.
Exactly, and that's why it's so crucial to stay informed. Constantly learn.
Evolving our understanding of how the market works.
Like Vermeulen said, the money knows more than the talking heads on TV.
Don't get caught up in the hype. Don't let fear drive your decisions.
Focus on the data. Focus on those trends, those fundamentals.
So, as we wrap up this deep dive,
What are some key takeaways? What can our listeners actually do to navigate this market uncertainty?
it feels like a bit of a minefield out there sometimes,
Well, first and foremost, never underestimate the power of cash.
especially in times like these.
Having that reserve, that financial cushion, it gives you flexibility.
It gives you options.
And it allows you to seize opportunities when they arise.
That peace of mind is priceless.
Second, diversify. Diversify.
Like those alternatives like gold.
It's been a safe haven for centuries.
And don't forget about the US dollar.
It could be a good hedge in this environment.
It's all about spreading the risk.
Third, keep an eye on the bond market.
Bonds? Really?
Vermeulen made a compelling case for their potential comeback.
If interest rates do indeed start to decline.
Bonds could offer a surprising combination of stability and growth.
It's funny how perceptions can change, isn't it?
They can. And finally, no matter what strategy you choose, no matter your investment style,
Have a plan.
have a system.
A set of rules that you follow consistently.
Discipline is key. Whether you're into asset reeves, value investing, long-term buy and hold.
A disciplined approach will help you navigate those inevitable market ups and downs.
With much more confidence.
So it's not about predicting the future.
It's about being prepared for anything the market throws at you.
And that brings us back to Vermeulen's final thought. That thought-provoking question he left us with.
What if this current market trend continues?
What if bonds do end up outperforming stocks,
What if investors start flocking to safety and stability?
moving away from those riskier bets?
What would that mean for the future of investing?
It's a question worth pondering as you continue your own journey in the market.
This deep dive has certainly given us all a lot to think about.
It has. Thank you so much for joining us today.
If you'd like to learn more about Vermeulen's work
His Asset Reeves strategy.
and thetechnicaltraders.com,
You can find more information on their website.
until next time.
Happy investing, everyone.